Alright everyone, welcome back. Now today I'm going to be going over a dividend based portfolio update. There's been a few growth related episodes that I've been putting out, and I want everyone to know that I haven't forgotten about dividend based investment. That's definitely not the case. And so that's why in today's episode I want to be going over some of the actions I've been making within my dividend based portfolio. Now for those unaware, I use the Trading 212 portfolio where I hold only dividend based companies. You can see them listed on the side of the screen here, just scrolling down so you can see all the companies that I have an open position in, and there's certain companies where I hold more weighting compared to others. So you can see Persimmon. For those unaware, this is a UK based holding company where they focus primarily on home-based businesses. Now, somewhat similar to growth-based strategies, we can see that for certain companies that are providing a nice dividend combined with a decrease in the stock price, sometimes those can be favourable, assuming the company has a solid track record. Generally speaking, if you have a company with a dividend yield over 6%, then you're generally looking at dangerous territory, given that the company may stop providing dividends, given that they're paying out a negative amount compared to what they're earning. But when we look at the likes of Persimmon, we can see a debt to assets only 24%. We see the dividend yield at 16.7%. It's dangerously high, but that is pushed down compared to the 19%, which I ended up buying a large amount a few months ago. And as I say, I normally tell people to focus on companies that pay at most 5%, given that you're guaranteed to have a solid return rate with the high possibility of increased dividends year over year. But with a company like Persimmon that is paying dangerously high, at the same time, that's just because the underlying stock price decreased a large amount, which has increased that dividend yield value. So eventually, and hopefully if the stock price pushes around say £18 or so, then that dividend yield will be, at the top of my head, around 10% or under. And so that's one of the decisions you have to make. Although we might be buying into a company that has dangerous levels with dividend payouts, we have to ask if this company is going to be able to bounce back, set that value to a more sensible level, which is governed by an increase in the stock price. And my personal belief, others may have a different opinion, but I do believe that Persimmon is a company that's able to at least get to the £15 or so, and hopefully all the way back up to the £18 mark. We can see currently I have a return negative of 8.17%, but it's my largest holdings to date, which is why I wanted to focus on Persimmon. There's other companies out here. All the companies in the green are performing well, and then the ones in the red are underperforming. We can see Intel, I believe, is the most negative company, which is why with the dividends that I received from other dividend-based companies, I ended up buying £32 worth of Intel, equating to 1.42, and those were funds primarily from Rhythm Capital. Now, taking a bird's eye view, we can see that the total dividends that I have made throughout the lifetime of this dividend portfolio is £2,547. Let's not forget the 99 pence. On a month per month basis, I track this in an Excel sheet. There will be changes to this approach in the future. Now, I'm manually logging the amount each month. So we can see at the end of January with an account balance of £37,000. In the last month alone, I received £101. And so over a 12-month period, I'm on track to receive over £1,000. And we can actually start to see this cumulative effect where those dividends that are received then buy smaller portions of the same or different companies that are also paying out dividends, and that further fuels the growth process. Unlike the growth-based techniques that I'm mentioning on this channel, sometimes it's just easier to sit back and let the account perform on its own. I've set aside the selling portion because I don't sell, and then starting to automate the buying process due to the dividends received in the form of cash, which is then reinvested into stock. We can see the breakdown here, investing over £32,000 with a return over 5%. That equates to over 16%, which is much better compared to a few months back that we were seeing just a small 7% return rate. And it's no surprise I've just been focusing primarily on my growth-based portfolio. For those unaware, I've dedicated different videos using the Lightyear app, so do check those out. But I haven't been investing any of the money within the account down here. These free funds are just from the dividends. But over the entire year, I've put in 22% of my ISA allocation, so that's over £4,000. which I ended up buying Persimmon stock. So let me know in the comments below if you have a dividend-based portfolio. If there's any companies you've been adding into your portfolio, comment below and let me know which ones you've been purchasing. New videos are posted each week. Thanks to everyone who's been subscribing. If you have any friends out there that might find this content of interest, do share any of these videos with them. And with that said, I'll catch you in the next one.